If you're paying attention to the markets right now, there's one thing you absolutely can't ignore. Semiconductors are on fire, not just warming up, not gently recovering, but roaring back with real momentum. In April 2025 alone, global chip sales hit a stunning $57 billion, according to the Semiconductor Industry Association. That's a 2.5% jump from March and a jaw-dropping 22.7% surge year over year. And this isn't just some isolated recovery. We're seeing action across the board. Chip sales in the Americas exploded by over 44%. The Asia-Pacific region posted a strong 23% gain, and even China, despite all the geopolitical tension, managed a solid 14.4% increase. The semiconductor supply chain is finally stabilizing, capital investment is picking up again, and a new generation of products is flooding the pipeline. Let's kick things off with a company making bold moves right out of the gate, GlobalFoundries. Ticker GFS. GlobalFoundries is turning heads after announcing its plan to acquire MIPS, a major player in CPU design. This isn't just another business deal, it's a strategic leap to supercharge GlobalFoundries' AI and computing capabilities. MIPS is well known for its RISC-based CPU designs, foundational tech that's been around for decades. By bringing that intellectual property in-house, GlobalFoundries is aiming to build energy-efficient, scalable processors tailored for AI, edge computing, and next-gen data centers. This move reflects a larger trend in the chip world. Foundries aren't just content with manufacturing silicon anymore. They want to own the innovation pipeline too. With the MIPS acquisition, GlobalFoundries steps into a new role, not just as a supplier, but as an end-to-end tech powerhouse. And that could unlock major growth as demand for smarter, faster chips continues to soar. But before we dive deeper, here's a quick question for you. If AI is the gold rush, do you think chip makers like GFS are the ones selling the shovels? Comment your thoughts below. I want to hear which side of the trade you're on. Now let's talk about MACOM Technology Solutions, ticker MTSI. Analysts at Stifel recently raised their price target on the stock from $140 to $155, maintaining a buy rating. With MTSI currently trading around $137, that spells potential upside. But this is more than just a ratings boost. Stifel believes the long semiconductor inventory correction might finally be in the rearview mirror. And for investors, that could be a game changer. What makes MACOM compelling is its exposure to AI infrastructure. The company specializes in high-performance analog RF, microwave, and photonic semiconductors, all critical in powering data centers and 5G networks. As AI infrastructure spending continues to rise, MACOM could be perfectly positioned to capitalize. Stifel forecasts 32% revenue growth in 2025, followed by 17% in 2026 for companies in this space. If you're looking for a play in the AI and connectivity boom, MACOM deserves a spot on your radar. Next up, Analog Devices, ticker ADI. Morgan Stanley recently bumped their price target from $212 to $273, signaling a 15% upside from where the stock currently trades. Why the optimism? Analog Devices has carved out a powerful niche in high-performance analog and mixed-signal chips, the kind found in everything from industrial robots to autonomous vehicles and 5G towers. What sets ADI apart is precision. They're not chasing mass production. They're chasing excellence in performance and reliability. Their chips serve mission-critical systems that need real-time responsiveness and absolute accuracy. And as industries race toward automation, electrification, and AI integration, that precision becomes even more valuable. Add to that a strong balance sheet and robust cash flow, and you have a company with both the resilience to handle short-term shocks and the capital to double down on long-term innovation. For investors who want dependable growth, ADI stands out. Now let's zoom in on ASML, ticker ASML, a company that doesn't just participate in the chip boom, it enables it. ASML is the only company in the world that makes EUV lithography machines, the ultra-sophisticated systems needed to manufacture today's most advanced chips. Without ASML, companies like TSMC and Intel couldn't even begin to produce cutting-edge semiconductors. Recently, Kempen & Company gave ASML a hold rating, but still raised their price target to $761. While there are some short-term headwinds with order flow, analysts agree ASML's monopoly-like dominance is practically untouchable. As demand for advanced chips continues to climb, especially in AI, data centers, and high-performance computing, ASML's equipment remains mission-critical. If chip innovation keeps moving forward, ASML gets paid every step of the way. Up next, let's talk about Qualcomm, ticker QCOM. UBS recently raised their price target to $165, while the stock is trading near $157. Qualcomm's upcoming earnings are expected to get a slight lift due to early shipments, sparked by trade uncertainty. But analysts aren't expecting that short-term trend to last, especially given ongoing weakness in smartphone and PC demand. That said, Qualcomm is evolving. They're not just the phone chip company anymore. They're expanding into automotive chips, 5G infrastructure, and AI-driven processors. Their silicon is powering everything from smartphones to self-driving cars, making them a quiet giant in the smart device revolution. The momentum might not be red-hot right now, but the long-term strategy is solid, and for patient investors, that could pay off. Now let's break down Applied Materials, ticker AMAT. This is a name that often flies under the radar, but it's absolutely crucial to the chip-making ecosystem. Needham recently raised their price target to $240, suggesting 28% upside. Their bullish stance is backed by the fact that wafer fabrication equipment spending is ramping up again, and Applied Materials has a hefty backlog of orders waiting to be filled. The company is deeply tied to both logic and memory chip production, making it well-positioned for the next big wave of capital investment. As governments and tech giants ramp up domestic chip production, and as AI continues to drive demand, Applied Materials is in the right place at the right time. And finally, let's talk about Micron Technology, ticker MU. Arete Research just raised their price target to $150, which is nearly 38% above the current trading level. Why the optimism? Because Micron is squarely in the sweet spot of the AI and hyperscale data center boom. Their HBM3E memory chips are crucial for training and running large AI models, and demand is climbing fast. Micron's edge comes from both timing and tech leadership. The memory market is rebalancing, pricing is rising, and margins are improving. As hyperscalers race to build out infrastructure for AI, Micron's next-gen memory chips will be front and center. For investors, it's one of the most direct plays on the future of AI computing. Now let's take a quick look at the numbers. And honestly, the data speaks volumes. Starting with stock prices, ASML is by far the most expensive at $688.96, followed by MACOM at $138.45, and Analog Devices at $221.06. On the flip side, the most affordable stock on this list is Global Foundries at just $32.50, which could catch the eye of value-focused investors. When it comes to market cap, ASML once again leads the pack with a massive $275 billion, while Qualcomm and Applied Materials follow at $159 billion and $147 billion, respectively. MACOM is the smallest in terms of size, coming in at $10 billion, but smaller market caps can sometimes mean more upside potential if growth kicks in. Now shifting to revenue, Qualcomm tops the list at $39 billion, and ASML isn't far behind with $31 billion. Micron and Applied Materials are also strong contenders with $25 billion and $27 billion in revenue, while MACOM brings in a more modest $730 million. Gross margin is where profitability gets interesting. Qualcomm boasts the highest at 55.68%, with ASML and MACOM trailing close at 52.52% and 51.80% respectively. Micron, by comparison, sits at the lower end with 37.33%, but that's still respectable for a memory-focused chipmaker. As for dividend yield, Qualcomm leads again at 2.3%, while Analog Devices offers 1.7%, and ASML gives 1.0%. The rest either don't pay dividends or keep them very low, like Micron at 0.4%, which suggests a heavier focus on reinvestment over income. And finally, earnings per share tells us who's truly profitable. ASML is ahead with a whopping $26.10 EPS. Qualcomm sits at $10.37, and Applied Materials posts $8.22. At the other end of the scale, Global Foundries and MACOM are still in the red, with EPS of -0.35 and -1.22, respectively. So whether you're hunting for strong EPS, high margins, or just a good entry price, this table makes it clear. The semiconductor sector offers a wide spectrum of opportunities, and each stock tells a different story through its numbers. One last thing before we go. Do you think the semiconductor rally is just warming up, or are we already late to the party? Drop your take in the comments, let's see what the smart investors think. And here are 6 stocks surprise Wall Street with double-digit gains. Click on this video here.